Thanks for tuning to today's Talking Point. I'm your host, Neeraj Shah. One of my favorite guests joins on the show today. It's an absolute delight to speak to Maneesh Dangi of Macro Mosaic. He joins us. Manish, great having you. Thanks for taking the time out.
Good morning, Neeraj. Happy being
Uh,
here with you.
Thank you. Manish, I'm going to take a leaf out of some of the posts that you put on LinkedIn, as well as some of the thoughts that you would have expressed, and trying and interspersing it with a couple of questions that I've put in. I want to start off with your stance, which you probably took about a month ago on the mother market, which is the US markets. And there are a lot of follow-ups that have happened from other writers that I've read, who speak about how if you just look at the earnings yield relative to the real yield, either on the short or the long dated treasuries, there's a technical reason why you shouldn't hold US equities. You, of course, had a lot of other reasons too. Tell us how you think about that piece, and if you can correlate it to what could the impact of a slow or a lower grind down in US equities could mean for other risk assets.
Neeraj, so in US's case, we actually chose to exit about a fortnight ago because we thought the market had actually swung from one extreme, which is a recession is here and a hard one, to no recession or a complete softish landing in 2019, like. So, in a sense, there was little in market, and basically first, before the valuation, a basic idea that any significant tightening almost always, or should I say always, result in recession. And there's been a very, very severe tightening in US for last 1 year, near 5% interest rate hike, and the internals of markets were looking weak there in US. The cyclical sectors, particularly housing, started to look weak. So there were macro reasons why markets, were they seemed unprepared for a potential recession, which we thought at least that there was higher probability than what market was assigning for. Second is that, of course, the basic math that I thought of, if historically, if there were to be recession, Neeraj, you would see about 25-30% fall in earnings. Markets right now are baking in about $245 of earnings in 2024. And if there were to be recession in US, it would be more like $200 for S&P 500. So effectively, markets were trading 23 times of 2024 earnings in US. And if there were to be recession, as I said, it would fall to about $200, and that in turn would mean markets would fall by about 25-30% because the price to earning multiples in recession would not be more than 16-17 times at least. So these were the valuation reasons. Market seemed way too off versus likely or probable case of US recession. Of course, as you mentioned, earning yields in US relative to bond yields is another way to look at markets there. It's actually the same. Since last 10-20 years, you would see, like in last 10 years, earning yields would be about 3% higher. And in 2000s, it was about 1.5-2% higher. So again, one part of the market, which is equities, look too stretched. And which is why I think it made sense to de-risk. We had also made a decent amount of money. We dialed in December, we discussed with you. So almost 40-45% gains in NASDAQ. So that's the framework I use to sort of exit. Again, just a small point here that you could argue many times in 2022 the recession is here. So that bit a bit of a craft that it's now that I think that the likelihood of recession are increasing in context of market being completely dismissive of the arrival of it. So that's where the craft of actually putting out a trade for this exists.
Okay, and the hypothesis might be stronger now, and the relative gains that you made also played part there. Okay, but just sticking to fundamentals, independent of what trade you were in, Manish, there was a LinkedIn post that you put out which spoke about how if you just look at the rising USD, that's a great universal stress indicator. Now I'm trying to juxtapose what's happening in the US versus the rest of the world, because we know Europe is not in a very sweet spot. We know China is actually struggling at the margin, or actually a full blown struggle, if you will. Is this a key indicator, and what would this indicate for risk assets worldwide?
Yeah, the dollar is as you sort of correctly pointed at, is potentially the most, at least to me, at least appears very, very credible financial condition index, and specifically in emerging markets, it works like a charm. In US, you could have a condition in which dollar and markets both appreciate together, but then it's almost impossible to imagine that a secular market is born of a strong dollar regime in India or any other country. It's given that, as a matter of fact, we all transact in dollar with the rest of the world. We trade and we borrow a lot of money. Our corporates borrow a lot of money, and whenever dollar conditions tighten for whatever reasons, be it of US or of emerging markets or of Europe, that puts a lot of weight on us, and our policies cannot be completely sovereign. We've discussed about it many times in the past. If imagine in 2013 we wanted to cut rates, but because there were to be a taper tantrum, we had to actually reverse it, and interest rates were to be hiked by 3%. Local conditions didn't warrant those sets of tightening. We were actually cutting rates into early June, July 2013, and we had to reverse it. So that's what, unfortunately, a dollar does. That it actually imposes an additional constraint which is non-local in nature. That just because Big Daddy is in a setup which demands that you have to literally actually tighten rates, even though your conditions are not suitable for it. So I think in the setup that we are entering in, if it's going to be a classic garden variety recession setup in US, you would actually see bonds in US actually rallying, but US dollar actually backing up or tightening. So it's not a 2022 setup in which both bonds sold off and dollar rally, nor it's likely to be a 2013 setup, as a 2019 setup in which Fed pivoted and our currency strengthened as well as bonds rallied. So it's a different typical garden variety recession setup in which a little bit of a risk off happens, dollar strengthens, but US bonds actually rally. And that is a sort of a bad news, Neeraj, but it's not the most malignant 2022-like setup. And in this scenario, of course, markets sell off, but it gives birth to the new business cycle and a new boom cycle in asset markets, and this is what we will wait for.
Interesting. Until that happens, Maneesh, while yields stay where they are or maybe slightly higher, and we've seen the evidence of a bit of a spark in the yields which have come off as well. But you make this interesting point in another LinkedIn post of yours that there is no evidence that higher bond yields would lead to lower multiples. Now, I don't know whether you are speaking in context with only the US markets or what could happen worldwide as well. So until the time that we see bonds rally and yields come off, what happens to multiples per se?
No, so higher bond yields actually, again, this is a macro tourist folks' ideas that bond yields are bad. Bond yields as such, because it incorporates two things: real yield, which is what you get compensation over and above inflation. Okay, so bond has two components: real yield and inflation. Okay, if let's say inflation in India were to be 5%, and so if bonds are delivering 7%, basically it's telling you that okay, I'll compensate you for inflation, and I'll also give you another 2% extra layer. That's risk premium for postponing your consumption. Simple understanding. Now, basically, because inflation is also part of earnings, right? Because earnings would also grow effectively. What is inflation? When you're saying CPI, WPI, whatever it is, actually corporates are charging a little more than what they were charging last year. So since it's part of both the equations, frankly, it doesn't matter. So if the bond yields are rising, without real yields going up, okay, it's actually good news for equities. In nominal terms, given the way we define bull market as an absolute nominal level, we don't call, you won't say that last 2 year Nifty is in bear market. I will call it, because in real terms, you have not made money. But you on TV and most investors would say, no, it's not a bear market because last 2 years, Nifty is up 10%. That's not the way to look at it, but that's the way people look at it. And if that is the way you look at it, then nominal yields don't matter. Again, I did this work that S&P 500, Nifty, again bond yields and delta and market delta is correlation is actually positive and very high, 85%. So basically they trend together. So in effect, Neeraj, if you were told that bond yields were not 7 and 9 and no other details, where would Nifty be today? Likely you should answer that it would be higher, again paradoxically, because it's very likely that it would be 9 for the reasons of inflation, and that would be mean higher earnings. The Nifty earnings would not be $900 right now, but maybe 1,000 or 1,200, and therefore the Nifty alone would be high. In real terms, Nifty could be lower, but you see, you get my point, I hope.
Yeah, no, and fair distinction, but yeah, I mean, the most commonly used way of or measure of looking at the Nifty would be what you said, Manish, that you may argue that it may not be the right way, but that's how the market looks at it, and that's how the narrative gets built up as well. So, I mean, I buy your point. Okay, so thanks. Because we have very limited point of time these days on conversations, I'm going to try and hop subjects now and try and get your views on a couple of other key talking points as well. I know you held fairly strong hypothesis on what happens on most things in the world, but specifically on China as well. I would love to understand how you are thinking about what's happening in China currently, because there is a narrative which economists, and I've read multiple of them, who say that China needs to do XYZ in order to get out of this growth slumber. And then there are people who say that China may not want to do it because it doesn't want more wild elephants, doesn't want to reflate the property bubble, so on and so forth, welfareism, etc. How do you, from your prism, look at what's happening in China currently?
So China, a very big picture is grinding down. From a 10%, 9% growth economy, it's grinded down to about 7% growth economy in last 10 years. And with perhaps in next 20, 30 years, we don't have much time to discuss, but most of the models, basis demographics and productivity growth suggest that it would get to about 4%, 3.5% to 4%. So typical of Japanification of China is playing out. The country is aging. Its productivity levels are very, very high already. An average Chinese already produces about 26, 27% of what a US worker produces. So that's pretty high. It used to be only 5% 20 years ago. So it's a very rapid sort of growth that China has experienced, and there is a decent weight of the fact that it's already risen so much. It's at early 2000s of Korea and mid 90s of Europe. So after these points, growth anyway begins to slow down. It's a natural course, and which is why I'm not in the gang that China is not collapsing. There is no data which suggests that China is collapsing. It's a sort of hyperbole. Yes, CNI is weakening. China's internals, markets have not done well, but it's not that the banks are not collapsing there. Yes, property market as such has slowed very remarkably, but again, it's a part of the policy which actually wanted it to sort of weaken. So China is a single balance sheet, Neeraj, unlike ours or USS. They could sort of shift weights around, and if there were to be a problem in, let's say, one set of sectors, they could make adjustments. They can backstop. So I think what is likely is a sort of a slow grind, a 4-ish growth in China over next 20, 30 years. But more likely in next 5, 10 years, it's going to be 5-odd%, 4.5%, 5%. So this transition from a 7 to 5 feels to us as if it's collapsing, as it did in 2015, but it's not. And the real reason why this propaganda goes on, of course, is it's more geopolitical in nature than economic.
Okay. In which case, Manish, how does money look at it? And the reason I'm asking this to you is that while this whole argument about how money gets pulled out of China into other EMs, and we've probably seen evidence of that post-March, though pre-March there was a large China investment as well. But coincidentally, yesterday we saw this Bloomberg chart which spoke about how the biggest China ETF has seen the largest monthly inflow in a really long time. We know valuations are attractive. Would you, as a global investor, be tempted to park money into China relative to some of the other EMs currently?
Absolutely, absolutely. China looks the cheapest at this point in time, and tourist investors, as I said, would move to China right now for next 2 months, as it did in India for the last 6-5 months. So there's a dry patch ahead for us, whereas a lot of, as I said, this fickle money, which keeps moving. Wherever there is a crisis, super depressed valuation, as it did to Nasdaq, a lot of money would have moved in, I'm assuming, I'm not the smartest of all, so would have moved in Nasdaq 6-8 months ago. Now I would move to China. So, but see, you ought to be very careful if you're a secular investor in China, because Russia awaits you there at some point in time. Because it's pretty hot between US and China, and so therefore very unlikely that big family offices would move in, but hedges would move there, and they would make quick buck. So I think that's a likely outcome.
Got it. Maneesh, now because you move so much in the global circles, you speak to large money bags in the world who might want to deploy money across the world, and arguably in India as well, given the right opportunity. I want a two-part question. One, how do you feel at the current juncture about putting money to work in India, both in the listed equities or otherwise? Part one. Part two, what is it that large global money is thinking about when they look at India as an investment destination? I know the overall color maybe that India is a great market at the right valuation, but I'm asking about the here and now currently.
Yeah, so it's basically, I mean, I was in US as we discussed, and the primary information that I received was that a lot of people who never thought of India as an investable market are beginning to look at it. So to that extent, when you look from outside, frankly, then you don't bother about a political cycle or a monsoon cycle. You look at 20, 30 years and seems like a decent place. Then comes the consideration of valuation and stuff like that. We can quibble, and for you and me it matters a lot, but to a very large family office, wants to move a structurally to some country, would think, okay, now this is part of our portfolio complex, and as and when portfolio manager advises, they can move. So it becomes part of what you call it, investable country. And so, the good news is that even though the global pool of capital is shrinking because baby boomers are retiring and so on and so forth for the demographic reasons, I don't think both FDI and FI flows is going to be strong for next 20, 30 years, and including next 5-10 years, contrary to what popular perceptions are. I think India would be sort of a favorite of amongst less favorite ones in the global setup. It's very unlikely to imagine that a lot of money move to China of these structural players, whereas it's very likely that India would receive.
Maneesh, what do you feel about currently investing into India? And I know again that the long term might be favorable. I'm just trying to understand the nuance here. Do you feel differently than the rest of the street, which believes that India is arguably the place to be in?
No, not at all. In a sense, India is very or moderately expensive, very expensive relative to China. Okay with vis-a-vis US, moderately expensive vis-a-vis our historic valuations. India's earnings, people who know the internals of it can realize that in last 5 or 10 years, revenues and GDP growth have moved in tandem, but earnings in last 5 years have detrended, have grown at 25-30% faster. And no one knows, frankly, in a lot of countries that I track, the earnings are sort of rolling over to the extent that they are mean reverting, so to say. If there were to be a trend chart, India's earnings are way off, and small part of it is explained by tax cuts and such like things, but it's very likely that at some point in time, a little bit of a soft patch and these earnings actually begin to mean revert. So you don't really have valuation comfort vis-a-vis history, and there is a small risk in India, and then never trade any beta markets, including India, if you can't solve for US Treasury and S&P 500 first to begin with. So if you're bullish as US Treasuries for reasons of recession, and if you're bearish S&P 500 for the reasons of earning potential sort of downgrade, then it's very unlikely that you'll be able to solve long Nifty. So basically exited in October 21 in Nifty, and then or continuously the idea is that because there is a bull market in dollar, always look for opportunities outside if at all. Otherwise, stay in cash. So that's the way sort of I grind my money pretty much across. So okay, to answer your questions, it's a long answer though, but mota moti, unless a emergence of new business cycle or a boom cycle emerge, which will happen as we discussed after a sort of a recession, garden variety recession like setup in US plays out in 2024 is when, some of the cleansing will happen in valuation in India, some of the risk with respect to El Nino and political cycle would somewhat fade. And then, we would be able to take a fresh look at markets. So that's for a more pure timing guy. Again, I keep mentioning to you that if you're a systematic investor, it doesn't matter, keep dialing in.
Got it. My final question, Maneesh, I know you have a flight to catch, but my final question, and that is a lot of corporates that I speak to, or actually some of the corporates that I speak to in select sectors, see the optimism around order flows, around the effects of the government capex to be similar to 2003 to 2008. But they say categorically that it is very, very specific pockets that we might see this in light of the fact that the globe is not in the same position that it was in back in 2003, 2008, but in all economies were also booming along with India. And therefore, right now, it is a very theme-specific moves that we are seeing. But some themes are or some businesses are very, very gung-ho about what's happening. And we can see either in the book-to-bill ratios or the capex that they have themselves announced, presuming that they know the cycle well. How do you feel about this capex cycle? Also in light of the fact that while a lot of announcements are made about global corporations investing into India through the FDI route, the actual numbers are probably not as strong as the narrative is.
Yeah, so FDI, we discussed 6-8 months ago, there's a myth actually that FDI is booming. FDI is not booming, and a significant part of corporate investment is actually FDI. And so that is, that's a big handicap for investment in India, corporate investment. It is a bit of a surprise actually on the other side that despite reasonably or enabling condition in place for last 1 year, why Capex is not moving? Your capacity utilization is very high, your banking sector is pretty squeaky clean, your corporate balance sheets are fine, great profitability numbers. Why Capex is not booming yet? We were to be in 2002 in 2022, then why 2003 is already not in? That's a bigger question to ask, and the answer to that is we've debated about it many times. No, you're not going to have a rerun of 2003-7. Setup is different. India is not as underinvested as it was then. There is no particular sector which sort of can attract the amount of capital that India needed to build then in 2003. So power, telecom, telephony, aviation, the kind of, what do you call, gangbuster capex growth that you saw then is unlikely to materialize in India, and which is in number, frankly. What I'm hopeful about is that Indian household actually begin to level up, and which is about half the capex. And if he begins to level up, there are signs of it. The households are taking more loans. The personal loan growth, particularly mortgage, is doing fairly decently. Even during ILFS, pre and post ILFS crisis, the retail actually did reasonably well. So there is a small, I think there's a moderate possibility that the household actually level up. So if I were to take a big picture review for next 10-15 years, household is going to drive capex, not the corporate. The corporate will actually will grow, but unlikely that it would actually do too well relative to what market expects right now.
Okay. And my final question on this conversation, that is with regards to, again, a LinkedIn post that you made. And I was trying to understand if you actually believe that, or was this merely used as an indicator for the future, if you will? Is that when do you see stress in the corporate balance sheet or the cap or the cycle? Is when the working capital cycles change, payables balloon, etc. Do you see any signs of that within India per se?
No, none at all. In a sense, one area which we are actually truly like 2002-3 is corporate balance sheets. This squeaky clean, as I said, absolutely. And so is banks are actually better than what they were in 2002-3. They're much more well aware of a potential risk. But then in 2003, banks were innocently entering in a regime in which they thought that it's truly believable India story, and every cement and a telephone guy or a aviation guy or a power guy could be lent to, okay, potentially without any equity from the shareholder, okay. They're well too aware of it, and which is why from Axis to ICICI to they have these motherhood statements unspoken though that we shall not lend to in projects and project finance. So who is going to do project finance in India? We have not solved for it yet. So we've moved from a 2003-7 go-go years when everyone wanted to lend to this and that guy's project to now a setup in which everyone wants to do just the mortgage. Okay, we've not solved project finance. So in a sense, that's the supply side. So while the supply side on the on banking balance sheet in aggregate is absolutely nice. Okay, high CRAR and stuff like that, and corporate balance sheets are also nice. But then the project finance, what do you call pipeline? The pipe which supplies capital to new project, okay, which in erstwhile era in 90s was done by ICICIs and IDBIs, and later in 2000s it was done by, and even in 2010s it was done by all banks, not FIIs. Now all banks have concluded, no, we will not do it. So who will do it? Okay, so to that extent, it's constrained supply of. You get my project finance is different than what do you call a nimble, incremental stuff that Vedanta or Reliance Industries does. I am setting up a new project somewhere, new power plant. Can I get money for it in a ring-fenced manner? It requires a lot more equity today than what they needed in 2010s and 2000s. So that bit of a debt capital supply is not in place. No mutual fund wants to do credit today, which was supplying a little bit of equity to the project financiers in form of loan against shares and stuff like that. No bank, I would say I'm overstating my case, but the banks are generally reluctant to do project finance unless a lot of equity is already come in, which wasn't the case, in 2000s. Bankers would recollect, and so which is a bit of a supply side issue.
Yeah, I was about to say that it's not that they are not completely. They are here, banker after banker, talking about them wanting to do it if there is a project which is suitable. Maybe the equity angle that you spoke about is the suitability aspect that might be missing in some of these applications, if you will.
Yeah. So in a sense, this is the thing, right? That bankers are always for business. What is the condition precedent? In 2000s, all you need to say is that, okay, I am this and that from Hyderabad and I'm setting up this and that, what do you call power plant? Would you give me money? And 5,000 crore, 10,000 crore sanctioned. Now there are many conditions have to be in place. Equity has to come in and substantially more than what they needed in 2000s and early 2010s for ICICI to actually disburse loan. So these are the reasons which are supply side on the capital side. Even though the banking balance sheet is squeaky clean, it's actually ready to dial a lot of mortgage loans, but not ready to dial a lot of project finance.
Point well taken. Maneesh, thank you so much for taking the time out and being with us today and giving us your thoughts. We won't hold you more. Have a safe flight and look forward to talking to you more often.
Thank you very much.
Thank you. And viewers, thanks for tuning into this edition of The Talking Point.